Today we have the honor. Today we have the honor of inviting Mr. Ron Ricard, and he is the Vice President and Regional Account Manager for IPX 1031 Exchange in Northern California, and he is also designated as a Certified Exchange Specialist. And since 2002, Ron has taught 1031 Exchange accredited courses to over 30,000 investors, real estate agents, and others. And Ron is a professional when it comes to helping to understand the details of 1031 exchange rules and regulations. And he has served on the board of the Santa Clara County Association of Realtors and the Commercial Broker Association, and is very involved with numerous real estate associations and industry groups throughout Northern California. So let us hear Ron on what he will share with us. Ron, are you ready?
I am. Thank you very much, Monica. Thank you for the nice introduction. Let me go ahead and I'm going to share my screen here. If you can, there we go.
Yeah, sure. That would be great. Yeah.
All right. So hold on here. Let me get.
Yeah, we can see it.
Wonderful. Thank you, Monica. My name is Ron Ricard. As Monica says, I've been doing this for more than 20 years now, and I've spoken at your group in person many times over the years. But it's the first time I get to introduce you via Zoom. So welcome and thank you for coming today. Again, my name is Ron Ricard. We're going to be talking about 1031 exchanges. And if you have questions, my talk is only going to last about 35 or 40 minutes. As you have questions, please put them in the chat box. And at the end, we'll go through the chat box and questions people may have. But we'll be here to answer everybody's questions. If for some reason I don't get to your question today, feel free to call me or email me with any follow-up questions. My job is to help you understand what 1031 exchanges are. All right. So just kind of from the beginning, I know that most of you probably already have an idea of what exchanges are. The 1031 just refers to a section of the tax code. Tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you've made. So you have a rental house, you want to sell that and buy a fourplex. So you list the property, you go through the process of selling that property. At the close of escrow, the money comes to a third party called the intermediary. That's what we are. You then go find that fourplex you want to buy. We send the money to the title company there, and that's your exchange. You sold investment real estate, you bought investment real estate, and because you never touched the money, you get to defer paying taxes on the profit that you've made. Now, that is an important word, defer, not eliminate. Okay, so if you sell the house to buy a fourplex, and later you do another 1031 exchange and you sell that fourplex and buy a sixplex, and now you're tired of real estate, well, when you sell that sixplex, you pay taxes from the house, the fourplex, and the sixplex. You are just deferring the taxes. Now, sometimes people will ask me, well, why bother doing an exchange? Why should I do an exchange if I'm going to have to pay the taxes anyway? There are two reasons we always want to do the exchange. Number one, would you prefer to pay your taxes today or tomorrow? For most of us, the answer is tomorrow. The way I look at it is if I make $300,000 of profit on something and I have to pay $100,000 in taxes, well, because I get to do the exchange, I don't have to pay that $100,000 and I get to use that money to buy more real estate. So it helps you build your wealth faster. But the real reason you do the exchange is most of us will never have to pay the taxes because sadly, one day we're all going to die. And when you die, you win. Well, be honest, when you die, your kids win. Because when you die, your heirs get what's called the step up in tax basis. Now, make sure everyone understands this. If I buy a property for $100,000 and today it's worth $1 million, if I sell it, I have a $900,000 gain to pay tax on. But the day I die, whoever inherits that property, their basis, their value is the value of the property the day I die. And if your kids are like mine, the day after my funeral, they're selling all my real estate. And when they sell it for $1 million, how much capital gain do they have to pay? Zero. It was worth $1 million when I died. That effectively becomes like they purchased the property for $1 million. Now, when they sell that property, they have zero gain. Now, if they own it for many years and it goes up in value, then yes, there will be gain in the property. But all the gain that I would have paid tax on all disappears. Now, one thing to remember, this is only true if you inherit the property, not if you give it to your children before you die. So that's why the way the tax code is written in the United States, it is much better to inherit property than it is to have it gifted to you while you're still alive. But anyway, now there's a term you hear a lot in exchanges, and that term is like. As a matter of fact, if you ever call your accountant or attorney, he doesn't call them 1031 exchanges. He called them like kind exchanges because that is what they're often known as. This term like kind, though, is very confusing, but it's very simple, actually. Any kind of investment real estate can be exchanged with any other kind of investment real estate. Also, you can exchange anywhere in the United States. So you can sell your rental house and buy a shopping center. You can sell your farm and buy an apartment building. You can even sell bare land and buy a rental house or rental condo or shopping center. The key is it's investment real estate for investment real estate. Also anywhere in the United States. So you can sell in California, buy in Florida, buy in Hawaii. I would say one of the things that Monica and I was talking about before we went on is how many exchanges we're doing right now. And right now we are doing record numbers of exchanges, not just us, but our whole industry is. And a lot of it is people buying properties in other states. And we'll talk about why they do this later, but it's okay to buy in other states and you are still deferring both state and federal taxes. Now, the reason that term like kind is so confusing is because up until recently, we used to do a lot of exchanges on things that were not real estate. For example, we would do exchanges for airplanes. We would do exchanges for farm equipment. I've done exchanges for livestock, artwork. And so that's what like kind meant. If you sold a boat, you had to buy a boat. If you sold farm equipment, you had to buy farm equipment. That's what like kind referred to. But as of 2017, all personal property exchanges are gone. So that's why now you cannot exchange your interest in your business, because before a lot of people wanted to do exchanges with assets from their business. You can't anymore. Now 1031 is only about real estate. But again, any kind of investment real estate for any other kind. Now, I did say, though, it has to be investment real estate. So what kind of real estate is not investment? Well, your primary residence, where you live. Now, in 1997, Congress changed the rules because before then, when you sold your house, you had to go buy a more expensive house. That's not the case anymore. Now, when you sell your house, you get an automatic exemption. You get to keep, if you're single, the first $250,000 of profit tax-free. If you're married, that's $500,000. Now, back in 1997, when they put in these limits, that was a lot of gain. Most of us would never see those gains, but that's not the case anymore. Now in the Bay Area, we have a lot of people, in fact, I would say most of the Bay Area, their gain on that property, if they've owned it more than a couple of years, is way more than $500,000. Or if they're single, more than that $250,000. Is there anything else they could do? Because right now, if you sell your house as a primary residence and your gain is more than the exemption, you pay tax on whatever that excess gain is. It does not matter what you do with the money. It does not matter if you buy another house. It does not matter if you buy an investment property. You cannot do an exchange if the property is only your primary residence. But can a property be both an investment and a primary residence at the same time? Yes. First off, do you rent out any of your house now? Do you have an ADU? Do you rent out the basement? Do you have a home office? The key here is, what are you showing on your tax return? You are showing on your tax return that a percentage of your house is home office or a percentage of your house is rented out, then you can do an exchange on that percentage of the sales price. It is very important that you have been showing this on your tax return. I personally have a home office, but because I don't qualify, I don't show it on my tax return. So I, according to the IRS, do not have a home office. But if you do and you show it on your taxes, then whatever portion it is. So, for example, in this example, you sell your property for $1 million. You've been showing 20% of your property as an ADU or a home office. Well, 20% of your sales price you can do an exchange on, and the other 80% you do an exchange with. So, I mean, the other 80% is treated like your primary residence, and you still get your full 250 or $500,000 exclusion on this. So it is a way for you to do both at the same time. Now, most of us don't have a home office. We don't rent out any of our property, but we still have a highly appreciated primary residence. Is there anything else we can do? Yes, move out. Turn your house into a rental property. Now, after you've been renting it for a year or two, is that house now an investment? Yes. Is it still considered to be a primary residence? Yes, because it still qualifies for the fact that you have lived in the property 2 of the last 5 years. So the day you sell the property, you look back at the last 5 years. Did I live in the property at least 2 of those? If the answer is yes, you get to take advantage of both tax rules at the same time. So you get to keep the $250,000 or $500,000 and do a 1031 exchange on the rest. So this is a way for you to combine it. Now, a couple of things to note here, very importantly. The first thing to note is that you have to do an exchange on everything minus the exemption. So if you sell your house for $3 million and you're married, you get to keep 500, but then you need to do an exchange on the remaining 2.5 million. It's not just the excess profit, it's everything minus the 250 or 500 you get to keep. Now, this does not work for everybody. If you need the money from your house to go buy a bigger house, this does not work for you. But if you have other places to live, or you have the money to go buy another property, or maybe you're moving into a facility that you don't need to buy into, then this is a very good tax strategy for people with highly appreciated primary residences. I will say again, if you have questions about any of this, please put them in the chat box. If you want to talk more about this later, you're welcome to call me. Now, what other kinds of properties don't qualify for 1031? Well, flipping real estate. If you buy something, fix it up, and sell it, the IRS says that that is not investment. The IRS says that that's a property purchased for resale, just like a business. You're buying something, fixing it up, and selling it. It's not an investment. Similarly, development is not an investment. So you buy a property, you build a house on it, and you sell it, or you buy a lot, you build a bunch of houses on there, and then you sell them. You are a developer. That is not investment real estate. Similarly, you cannot exchange into or out of partnerships or REITs or any other kind of real estate syndication, because those are not considered to be direct ownership of real estate. Now, there is one kind of asset called a Delaware Statutory Trust, which does qualify because it is considered to be direct ownership of specific real estate. But that's a very specific kind of property. But as a rule, if you're exchanging into partnerships or REITs, those do not qualify. Also, what does not qualify are second homes. Now, what I mean by second home is a property that you or your family are using for your own personal use. That is not investment real estate. Now, a vacation rental does qualify, but a second home does not. We'll get into that in just a second. Now, most of you are thinking to yourself, that's okay, I don't have a second home. But most of you do. You know why? Because you're letting your family member live there. If you have family member living in a property and you are not treating them like a regular tenant, including collecting market rate rent from them, it is not considered to be investment real estate. So be very careful about this. If you have family members or your children who are living in a property, you have to treat them like a regular tenant, including collecting rent and showing it on your tax return that way. So be very careful about family members living in your property. Now, what about vacation rentals? Now, this is something where vacation rentals do qualify for 1031 exchanges, but, and this is very important, the IRS has given us a very black and white definition of what a vacation rental is. So essentially, it is a property that you and your family cannot use the property more than 14 days per year or 2 weeks per year. Now, you have to rent it out, not the family, but you have to rent it out also at least 14 days per year. So at least 2 weeks per year. And you need to do this for at least 2 years. One of the things I see a lot of people doing today for their exchange is buying properties that ultimately they want to convert to a second home or sometimes even a primary residence. Well, here is a way the IRS has given us a black and white definition on how to do that and meet all the IRS rules. I call it the 222 rule. For the first 2 years you own the property, you must rent it at least 2 weeks and don't use it for more than 2 weeks. And then after 2 years, you can do whatever you want with the property, including moving into it. So this is a vacation rental. As a vacation rental, again, it does qualify for 1031. And again, in an exchange, what you sell and what you buy both have to be considered investment real estate. Now, there are a couple of important rules to know about when people want to do exchanges. The first one has to do with the timing. Now, some of you, if you've ever been through an exchange, you may be aware, hopefully aware of these timings because they are very important and they have not changed in 40 years. From the day you sell the property, you need to know what you're going to buy within 45 days. Now you have 180 days, almost 6 months to close the escrow, but you have to tell us what you're going to buy within those first 45 days. And when I mean identify, I mean you give us the exact address to what you're going to buy. Now, you can identify more properties than you're going to buy, so it does give you the chance to identify some backups. There's still a limited number that you can identify. I'm not going to get into that today. I don't want you to get too worried about that. But in today's market, I think that Monica will agree to this. In today's market, by the time you get to the 45 days, you really need to be in contract for what you want to buy. Because if you identify 3 properties to us, there's a very good chance on day 47, if you're not in contract with them, somebody else will be. So in today's market, by day 45, you want to be in contract. I always say in contract, have your inspections done and your loan approved. You want to be locked into a property by the time you get there. Now, let's talk about that 45 days a little bit more. The 45-day clock does start at the close of escrow. And the reason I say that's important is because I am seeing a lot of people these days when they sell their property ask for longer escrows. It's not uncommon for me to see a 45 or 60 or even 90-day escrow. The longer before the property closes escrow, the longer before the clock starts. Another thing to note, there are no extensions or exceptions. I don't care if your seller backed out. I don't care if you were in the hospital with ICU for a month. I've had that happen. I don't care if you went on vacation. The IRS will not grant you extensions based on your personal situation. Now, one more thing I will say about the 45-day rule, and I know that a lot of you have questions about this. There is something called a reverse exchange. And this is what a lot of people are doing right now because they are very much afraid of not finding a property within those 45 days. Maybe you have a very specific kind of property that you want to buy that you do not know if it will be available, and you're afraid. Well, there is a way you can buy the new property first. Now, if you go into contract to buy something, but you're able to sell yours first, then it's still a regular exchange. All we care about is when the escrows actually close. But if you need to close escrow on the one you want to buy before you sell yours, there is a way to do it. It is called a reverse exchange. Now, the first thing to know about this is you cannot buy that property and then call me. Because if you buy that property, you now own both of them. And you cannot do an exchange into a property if you already own it. So in a reverse exchange, we take title to the property. So you come into escrow to buy that property. We borrow that money from you, buy that property in an LLC that we create. Now, technically, you haven't done your exchange yet, but you then have 6 months, 180 days to sell your property. And then once you sell your property, then we give you the new property. So that becomes your actual exchange. So if in a way, we are kind of a placeholder that on title, waiting for you to be able to sell your property. A couple of things to note about this. Obviously, you need to have the money to buy that property. And most lenders won't work with you on this. Some will, most won't. The other thing is this is a more expensive type of transaction, whereas a regular 1031 exchange will cost you less than $2,000. A reverse exchange will cost you at least $7,000 or $8,000. Now, mind you, if we're talking $1 million properties, a few $1,000s extra should not be a big deal. But the reason I want to bring this up to you, if you are very much afraid of not finding a property because you have a very specific thing you want to buy and you find it before you sell yours, there is a way to buy first. Again, it is called a reverse exchange. Call me, we'll go through your specific situation. Now, the other big question when it comes to 1031 is how much do you need to spend when you're buying the new property? The answer is very simple. Everything. In a 1031, you are not just reinvesting your equity. You are not just reinvesting your profit. You are reinvesting everything. If you sell your property for $1 million, you need to go buy something worth at least $1 million. Now you could buy 2 or 3 or 10 properties that add up to $1 million. And you can sell 2 or 3 properties to buy one replacement. That's okay also. But the key is in total, you want to buy for more expensive than what you are selling. There is no limit as to how much more. If you sell for $1 million, you can buy for $5 million or $10 million. There's no limit. Now, can you sell for $1 million and buy for less than $1 million? The answer is yes, you can, but you pay tax on that difference. That difference sometimes is referred to as boot. Boot is what you pay tax on. But you want, as a rule, if you want no boot, if you do not want to pay any taxes, you want to buy something equal or greater in value. Now, the other part to this, which is very important, all of the equity, all of the cash that comes from the sale of the property, that's the cash that we're holding, all of that cash needs to go to the next property. If you get too big of a loan and you have cash left over, you pay tax on that cash. So it's equal or greater and use all that cash. Now, obviously, if there was a loan on the property, that loan needs to be replaced, either with another loan or with cash from your pocket, but you do need to replace the debt when you buy the property. For most people, they are getting another loan to replace the replace the loan that paid off. But again, if you have the cash instead, that's okay. So again, you're buying property equal or greater in value and using all the equity towards that new property. Now, before I get into the next part here, I just want to recap. The 1031 exchange itself is not a complicated process. You're selling investment real estate, you're buying investment real estate. You're using all the money that came from that sale towards the next property. You have a very limited window to tell us what you're going to buy in replacement, but overall, it is not a difficult problem. One question I should throw in here right now is we need to be involved in the transaction. As an intermediary, we must be involved in any 1031 exchange. We are a required part of an exchange as far as the IRS is concerned, and we must be involved before escrow closes on what you are selling. Because if you close escrow and you have not enlisted the intermediary, then the title company will send you the money when that property closes, and you will pay taxes. So that's why we have to be involved before escrow closes. Now, the next question, and this goes to kind of where we are in today's market. Why do people want to do 1031 exchanges? Most of you would think that you do exchanges because you want to defer taxes. That's not really true. If you don't want to defer taxes, the easiest thing to do is don't sell it. If you just hold on to that property and you're not selling it, you aren't paying taxes. The reason people do exchanges is because they want to buy something better. And what does better mean? Better means whatever it means for you. Maybe you own a lot of small properties and want to buy a bigger property. Maybe you own a big property and want to buy a lot of small properties. Maybe you're moving to Arizona, so you want to move your rentals to Arizona. Maybe you're buying property for better cash flow. Again, Monica and I were talking about this at the beginning. Why are people doing exchanges these days? Probably the number one reason people are doing exchanges these days is to improve their cash flow. Because in the Bay Area, prices for real estate have gone up anywhere from 30 to 50% in the last 2 years, but rents in most markets have not gone up. So you have a property that's worth much more than it used to be, but your return is not as much. So it's not uncommon for people to sell $2 or $3 or $4 million properties and take that money and buy multiple properties or buy properties in markets that generate better cash flow for them. So generating better cash flow is probably the number one reason people are doing exchanges. Also, looking to buy property that ultimately they may move into themselves. Again, this is the example we talked about, where you're going to do a 1031 exchange for your property in San Jose and go buy yourself a property in Hawaii. You're going to rent it for a few years, maybe a full-time rental, maybe a vacation rental. But when a few years from now, when you're tired of the Bay Area, you then sell that house, move to Hawaii, live there the rest of your life. So the idea of buying a property that ultimately will be a property they want to live in is another very common tax strategy, especially if they're looking to buy property outside of the Bay Area. Another common reason people do exchanges is for estate planning reasons. Because again, it is much better to inherit the property than it is to have it given to you while you're still alive. So a lot of times people will do exchanges so that their children know what they're going to inherit. I'm doing a couple of these right now. I'm doing an exchange for a gentleman. He's 95 years old, great guy. I've spoken to him many times. He has a very nice property, bare piece of land worth $6 million. Well, he has 3 children. What do you think his children are going to do with that land when he dies? The answer is fight over it. And I don't know if any of you have children, but that's usually the right answer. So what he's doing is he's doing an exchange and buying 3 properties. This way, when he dies, he knows exactly what each kid is going to inherit. There will be no fighting among family members. So again, the key here is you do an exchange because you want to reposition your money into what you are looking for out of your real estate. Whether you're looking for better cash flow, better location. One of the things that a lot of people do in today's market is do exchanges to make it easier management. So they're tired of managing their tenants. So especially once you're retired, you want to buy property that you don't have to spend as much time managing. So a lot of people right now are buying what's called triple net or net lease investment properties. That's where you're exchanging into like a McDonald's or a Walmart or a Jiffy Lube or a Starbucks. Basically, you're buying a building and leasing it to a major corporation. That kind of transaction is very easy to do. It's very, you have very long-term leases, typically anywhere from 15 to 30-year leases, and it's very predictable cash flow. So that's a common thing people get into when they retire so that they don't spend as much time managing their real estate. But again, what I want you to think about with your real estate, especially if you've owned that real estate more than 10 years, is this the real estate that you really want? If not, what are you looking for out of your real estate? 1031 is the tool that allows you to get from the property you own today into the property you want to own tomorrow. And when you think about it that way, 1031 is a very powerful tool. And real estate is the only asset that you can sell at a profit and not have to pay the taxes every time you sell it. So that is the best way to think about how to use 1031 exchange to benefit your life. All right. So with that, that really is the end of my talk. I know when I give this class live, there are usually lots and lots of questions, and I'm sure there will be now. I know there are a few in the chat box, and I'm going to ask Monica to start with those and see what other questions people have, and then we'll open it up to other people. Monica.
Yes. Thank you very much. It's very, very informative. Really enjoy listening to the updates again. So I have a question from Winnie, and she asked that she has already sold Young Lake for $2 million, the property she sold, net proceeds $1 million. And so after deducting all the expenses and mortgage, etc. So yeah, I think it's a simple question for you. How much do you think she should buy in order to qualify the complete, 1031 exchange gain, defer all gain?
So as I said, you need to buy equal or greater to what you sell the property for. Now you can subtract the realtor and escrow fees. So let's say you sold for $2 million and you paid your realtor 5%, then your net sales price is $1.9 million. You need to buy something for at least $1.9 million to defer all of your taxes. Also, that $1 million that hopefully is with the intermediary, all of that equity has to go towards buying at least $1.9 million worth of real estate, but it's equal or greater to what you sell the property for.
Yes. Yeah, got it. So a follow-up question that's from me. Say if like the client has 800,000 in debt. So if she's going to buy, say, 1.95 million, does she have to keep the same debt or can she pay it down a bit? So what would be the guideline?
Well, so let's use that number. So if you need to buy 1.95 worth of property and you just paid $800,000 of loan off, that means that as the intermediary, we're only holding $1.15 million. But you still need to buy 1.95 million worth of property to defer your taxes. So that $800,000 of debt that was paid off, you need to make that up. You can either get another loan to make that up, which most people do. But if you have cash in your pocket that you want to use instead of getting a loan, that's okay also. But yes, you do need to buy property equal or greater, which means replacing the debt. And for most of us, replacing the debt will mean getting another loan to replace the loan that we had.
Okay. So what if this client decided she does not want to, say, take on another loan, and she decided to buy, say, a 1.5 million property? So there's a difference, 400,000, because she's supposed to defer all gain that would be 1.95. Can she buy something at 1.5, and how would the tax be evaluated?
So if you need to buy for 1.95 and you only buy for 1.5, you have a $450,000 difference. You need to pay tax on that $450,000. Now, some of you are thinking, but I bought this property for a certain amount. I spent the money fixing it up. That doesn't matter. Any money you've spent on the property before you bought the property, that's called your basis. Those dollars are all rolled over. Those are the first dollars rolled over into the next property. So anything you don't reinvest, that $450,000 difference that Monica was just explaining, you have to pay tax on that entire $450,000. To the IRS, anything that you don't reinvest is considered to be from your profit and therefore taxable.
So accordingly, the long-term capital gain tax, so for federal, we heard that is either 15%, or if you're a higher income tax bracket, it would be 20%, depending on how much you make. And then the state income tax would be 9.3 to 12.3. and there's another 3.8%. Is it still the same rule? And did you hear anything like, Sui is asking, any changes in the tax law on the horizon?
Oh, thank you for mentioning that. I meant to say that at the beginning. So those are two different questions. So first one is, yes, the capital gains rate, when you factor in the 3.8% healthcare, and also remember depreciation recapture is taxed at 25%.
Yes.
So on the federal side, you can be looking at anywhere from 15 to 25%. On the state side, and round numbers for most people, around 10%. So for most people, the effective tax rate they will pay for most people is between 25 and 35%. And it can be as high as 38% in some situations. So yeah, it can get very expensive. So many of you might have read over the last year that there were people in Washington who wanted to change the 1031 rules or limit the 1031 rules. Sometimes, if some people are saying that people in Washington want to eliminate 1031. Here's the important thing to realize: nothing changed. Whenever anybody wants to do something make any major change, they will float a lot of proposals, a lot of different tax changes, a lot of different things that will happen. And guess what? By the time they put a bill in front of Congress, or the infrastructure bill, or the Build Back Better bill, Build Back Better, whatever they call it, nothing about 1031, nothing about capital gains rates, no changes were done to the 1031 last year, and it does not appear that 1031 exchanges are on the horizon to change in any way in 2022. Most of you don't realize is that 1031 has been around for over 100 years. It's been around since 1921. And so it's been around a very, very long time. And it's going to take a lot to get it out of the tax code. Right now, nothing is on the horizon. I'm not looking for a new job.
Okay, let me just continue with the follow-up question from Amy. So I think you have mentioned about that. If the case of 1.95 sell and only buy 1.45 replacement, can you deduct realtor fees? In fact, like maybe you can recap, or I just mentioned that the sales price is $2 million. Realtor fees, escrow fees, and other, say, recording fees may amount up to 5% or, $50,000. So that's pretty much is the net proceeds you need to exchange. Is that correct, Ron? Maybe you want to elaborate.
No, that's exactly right. It is the net sales price, but net just means subtracting realtor fees and title and escrow fees. You do not subtract the loan. It is so that's a lot of people, when they say net, think you subtract the loan. No, it only is title, escrow, and realtor fees. Those are called the non-recurring closing costs. Now, I will also add, when you buy the replacement property, if you're buying in counties where you are paying title and escrow fees, you can include those as well when you buy the replacement property.
The non-recurring closing costs. So
Correct.
What if, like, the client has done some improvement, say she spent about $50K improving on the property, it will become a cost basis. It will not be able to be deducted, right?
That's correct. Any money you spent on a property, whether it was 20 years ago or 20 minutes before escrow closes, any money that you spent on that property just goes to the basis on the property. It is not a closing cost, and it does not get factored into how much you need to spend as part of the exchange.
Got it. Yeah. So let me reach out to the questioner that Khalid has. He has two questions. So from your viewpoint, which is the better investment, triple net or DST? And what are the pros and cons?
Okay. What he's referred to, so those are two different, what I call, less easier to manage properties. So you have triple net, which is the complete ownership of a property, versus a DST, which is fractional interest in those same kind of properties. Which is the better? I can't tell you, because it really depends on what you want. I mean, let's talk about some advantages and disadvantages. One advantage of a triple net is you have control over it. It's your asset. You can sell it whenever you want. You can negotiate the terms. The negative is it might cost you $2, $3, $4 million, and all your eggs are in one basket. Whereas the advantage of a DST is that you can buy multiple properties, so you have diversified risk. But the flip side to that is a DST is not liquid. You only would sell that property when you would only sell the property when the property itself is sold by the people who put it together. There are companies out there, they basically are the equivalent of the general partner, and you are the equivalent of a limited partner. When the general partner decides to sell, that's typically 4 to 8 years. So your money is locked up. Now, that's the biggest pros and cons, the liquidity versus the diversity. So whatever is more important for you, that's where you can look at it.
Yeah, very good. His follow-up question is, what's your opinion of a monetized installment sale on a primary residence to defer taxes? It might be complex, but some companies say it's viable. What do you think? Installment sale.
The IRS last year said monetized installment sales are not valid. They are a misuse of Section 453, and they will disallow it. So no.
I see. So it's not viable. Yeah,
not viable.
Not permitted. Yeah. Let me ask you this. Say you mentioned about combined exchange for a primary residence. But if you are going to do a combined exchange for your primary, then you can save on some taxes. But then on the other hand, with the Proposition 19, that you can actually trade down and save the property tax base and transfer to your new residence. So you could either use one or the other. You cannot use both. Is that correct? Or can you use both?
If you find a way to use both, please tell me. But I've actually had this discussion with Larry Stone, the county assessor in Santa Clara County, and he is absolutely adamant. If you convert the property into an investment, into a rental, you can't do both. So as far as I am, no, you're exactly correct. I mean, and remember now, because of Prop 19, you don't have to buy down. You can even buy up and still keep your older property tax, at least for most of the property. And for a lot of people, this is a very important trade-off. What's it more important to you, to defer paying some capital gain tax, or to roll over your property tax basis? So it is a trade-off. What's better for you? That's something you have to look at with your own financials.
Got it. I come across a scenario. I have a client selling a duplex. So she decided to buy a fourplex. So she wants to do a combined exchange. But then she wants to live in one of the units of the fourplex and then do the exchange on the two units, okay? So I was told that it could be a split treatment. So in this case, can he keep the property tax base of the original duplex and then, use the other two units as investment? I don't know, this is just like a scenario that I think we need an expert to advise on.
Okay, so in the duplex, they live in one of the units right now?
Yes.
Okay, so there are two separate issues here. So there's the 1031 issue and the property tax issue. So let's talk about the 1031 issue. You sell a duplex, and we'll make it simple. It's a $2 million duplex. You live in half of it, rent out half of it. You still need to do an exchange on $1 million because that's the rental portion of that duplex. If you want to buy a fourplex that you're going to be renting out 3 of the 4 units, then as long as the value of the 3 rental units are more than the $1 million that you sold the rental unit on the duplex for, then you're okay on the 1031 side. So again, it's the investment portion of what you sell into the investment portion of what you buy. Now, with regard to property taxes, it has to do, you're going to see a proration. So let's say, so if you have a duplex where you live in half, rent out half, you would get to carry half of the property tax basis into the one unit of the fourplex that you're going to be living in, and you would pay full market property tax for the other 3 units. So it's the residence portion into the residence portion that you can roll over your Prop 19 or Prop 60 property tax base. Remember also, this is for people over 55 years old.
Yes. Yeah, wow, that's brilliant. I think it's an interesting solution to explore.
Yeah.
And yeah, so you mentioned that if, say, my clients purchase an investment, so he can rent it out for 2 years and then move in to the unit and use it as a primary. So he's thinking about staying there for 2 more years and then sell and get his Section 121 exemption as a primary. Will he be able to do that, or how is he going to pay the proration on the taxes?
Right. So that's a strategy a lot of people have. Move into your rental and then sell it after a couple of years. So first thing to realize is, if you do a 1031 exchange into property and then later move into it, the tax code says you must own the property, not live in it, own the property for minimum of 5 full calendar years. So you can't rent it for 2, live in it for 2. You can't sell it yet. So it has to be a property that you have owned for at least 5 years before you can do it. But the other thing to realize is there is no tax due when you move into the property, but there will be tax due when you sell the property, because you only get to keep a proration of the capital gain. So if you live in it for, let's say you rent it for 2 years and then move into it and live in it for 3 years and then sell it after 5 years, you've only lived in the property 60% of the time. So you only get to keep 60% of the capital gain, and you still have to pay the depreciation recapture back also. The reason I want to point this out, this is not a good tax strategy. The idea of converting the property to your primary residence, living in it for a couple of years, and then selling it is usually not a good tax strategy, because you're going to end up paying a lot of capital gain tax anyway. Now, the other thing to realize is the day you move into the property, it stops being investment. So if 6 months after you move into the property, you're sick of it and you want to sell it, too bad. It doesn't qualify for 1031 anymore, because the last use of the property was not as investment. Excuse me. So do be careful about that. But again, the key here is, though, if you convert a property from investment into primary and then later sell it, you only get to keep a proration of the capital gain. So you will have some capital gain.
Yeah. So they keep the proration, but they can continue to do another combined exchange.
No.
Is that correct?
No, because the day they move into it, it stops being investment. The idea of renting it, living in it first, then renting it, combination. Renting it first, then moving in, no combination, because the last use of the property was primary residence, not investment anymore.
I see. But what if they rent another 2 years?
Well, if they turn it back
Can they
into a rental,
qualify?
another story. Yeah, then they turn it back into a rental. Exactly. This is also why, if you start doing stuff like this, please make sure you have a good accountant.
Yes. Yeah, it gets complicated. But
Very.
like, say, like people want to know what are the ways to maybe get some cash out of it without having to pay taxes.
Well, remember, you can always refinance. You could refinance, pull cash out. You don't have to pay taxes when you refinance, but obviously you're just increasing your debt on the property, which a lot of people don't want to do either.
Mm-hmm. Yeah. So speaking about the reverse exchange, I know that you mentioned about like more costs involved. So there needs to be an LLC setup in order to buy the property first. So part of the fees that involved is for them to set up an LLC to acquire the uplink first and then sell it back to the client once their downlink is sold. So the LLC has to be a new LLC set up by the company, right? And then we cannot use any LLC that maybe the client has. Is that correct?
That is correct, because it has to be a new LLC, because you can't create an LLC and then buy it from your LLC, because that would be violating what are called the related party rules. And so there
Yeah, because
are,
the member, yeah,
right. And so that's why it has to be an LLC that you have nothing to do with. That's why we have to create it and own that property. And then once we're done, we'll give you the LLC. But ultimately, it's going to be it's something, that's why we have to be involved and own that property. It cannot be an LLC that you have had any interest in.
I see. So like for investment property, say my client's looking at selling a duplex and buying a fiveplex. So, for whatever reason, they can actually do it in cash. But during the holding period, the LLC that you form can continue to collect rental income and other, revenue
Right.
during the holding period.
Yeah, during the holding period, we actually lease the property back to you. So you're collecting the rent, you're making the paint, you're, getting management agreements, whatever. You effectively are still managing the property and collecting the rent. We are just on title as a placeholder. We are not collecting the rent from you. We are not mowing the lawn. That's still all your job.
I see. So apart from having a bit more fees that the client have to spend, they also have to close 2 escrow, right? One, when they purchase the uplink, and then the other escrow is when the exchange company sell it back to my client when they close on the downlink. Is that correct?
Not always, because sometimes, because what we can do sometimes is just give we can just give the LLC to the client. And if we just give the LLC to the client, they can now go then down to the county, get the property out of the LLC into their own name without having to pay an extra escrow or transfer tax. So that's why that's at least in California. I've heard, I just found out that Nevada still makes you pay a transfer tax, but in California, you can, if it's your asset and you're just getting it from your trust into your name or your LLC into your name, the county will not hit you with a transfer tax. And that's why we do this, to avoid having to go through that extra escrow.
But then the LLC is not part of my client, it's another entity. So would that incur any gift taxes or
no, because
trigger any property tax reassessment?
No, not at all, because the LLC is what's called a disregarded entity. The LLC is not a tax filing entity, so it doesn't create any tax liability. And again, because it is your LLC that we assign to you, so you're the full owner of. Because you're the full owner of it, getting it out of the LLC into your name does not trigger a tax reassessment.
I see. So the timeline is also 180 days from acquisition to the sale of the downlink, right?
Correct.
So if it exceeded 180 days, that would not be a successful exchange.
That's correct. You'd end up with both properties and paid a lot of money for nothing.
I see. Yeah. So like so far, did you see any failure on reverse exchange?
It happens occasionally. I mean, obviously, like if you go back to like when the market was really bad about 10 years ago, yeah, it did happen. People weren't able to sell their property. I've had a couple of situations. I mean, I would say that 99% of reverse exchanges are successful in today's market, and we are doing a record number of them. But occasionally, I know that for a variety of reasons, people end up not selling their property, and therefore it is not successful, but that's pretty rare.
Yeah, so ended up, if they do not sell, that means there would be no tax impact, but they just buy another new one with some more costs. Right now, you mentioned that the exchange activity are very, very heavy. So most of the people, are they doing the 3 property rule, or are they anybody doing like 200% rule or the 95% rule? Maybe you can explain a bit, because we do have many clients buying multiple properties and out of state now.
Okay, so again, there are 3 different rules for when it comes to identification. The key about those is though that the idea is that if you're only going to buy one or two properties, you can identify up to three. If you want to buy more than three, then you typically would identify under the 200% rule, which allows you to identify two times your sales price. So if you sell for $1 million, you can identify $2 million worth of property. Obviously, this is you would only use this if your goal is to buy lots of small properties. What are people doing? People are doing everything. I would say probably the majority of clients are only buying one or two properties, but there are a lot of people, especially if they're taking their money to places like Tennessee or Florida or Alabama or North Carolina, where they're buying 3, 4, 5 properties. And so obviously then there they will use that 200% rule. But again, I'm going to go back. Most of the time, by the time we get to the 45 days, they already know exactly what they're going to buy, and they don't really worry about the identification because they're already in contract on everything.
Yeah. So of course, we definitely encourage people who attend today's event. If you have more details to inquire, can reach out to Ron directly.
Yes.
I think one of the attendees, Sunny, and he asked, if he has specific questions, will you be able to help him to address it? And would there be any charge for consultancy?
Nope. My job is to help people, and we only get paid if you actually do an exchange. So you're welcome to call me or email me or text me with any questions you might have. If we could schedule a meeting if you want, or schedule a call if you want, or you could just call me at your convenience. My job is to help you. So I'm on the phone a lot all day long talking to people. So I do not charge for consultations.
Yes. So we're going to send out Ron's contact that you would be able to reach out to him. But if you have other questions about the real estate market or what are the good outlets or alternatives, you can also contact us. We run the Investor Club, and so we do have a lot of resources, and we've seen many scenarios that we can share with you some of our experiences. And I do have maybe a few more questions that because some of my clients are doing exchange now, and they do want me to ask that. So if my clients are buying an apartment, so like 4-plex, there would be security deposit to be transferred to them, and they're using the proceeds to buy. And they're paying for insurance of that property. Like
Right.
You mentioned about the non-recurring closing cost. And they also, sometimes they would establish an impound account that they're paying property tax and insurance inside the escrow. For some of this, can we actually be using the net proceeds to pay, or would that be taxable?
Okay, so anything that's not a closing cost, like property taxes, insurance, HOA, impounds, that would be that if you pay it through the escrow, it does not invalidate the exchange, but it would be viewed as taxable boot. So similarly with loan fees, loan points are technically not considered to be closing costs according to the IRS. So if you pay loan fees and loan points at the close of escrow, again, it does not invalidate the exchange, but it does create boot for having used that money. When it comes to security deposits, I'm a big fan of doing that outside of escrow. So if you can just have those transferred, like a bank account from one account to the other, that's an easier way to do it. Because if it looks like those funds are being credited against the purchase price, it could be viewed as boot as well. So that's, unfortunately, this is another area where you need a really good accountant to make sure he's helping you with that. But again, anything that you pay out of escrow does not invalidate the exchange, just might create a small tax liability for you.
Got it. Well, I have one last question. I don't know if other people may. So it's about your company. So you mentioned about a regular exchange about $2,000. How would the breakdown be? And if I'm selling a property in California, say $1 million, and then I want to buy one in Texas and then two in Florida. So like, do I just have to deal with you, your counterpart in California, or do I have to deal with people who are, say, in Texas or Florida to complete the exchange? How does it work?
Okay, so first off, the fee for the 1031 is a flat fee. Right now, it's $950 when you sell your property, and then $250 for each property you buy. So if you just sell one, buy one, it's $1,200. Obviously, if you're buying multiple, then it goes up. But so $950 on the sale, $250 on the purchase. And I do exchanges all over the country. I've literally done exchanges to every single state in the country in the last 12 months. So buying in Texas, buying in Florida, not a problem. Our job is to be what I call the escrow between the escrows. We work with a title company here, and then we work with a title company in Texas or Florida or wherever you're buying. In some parts of the East Coast, they use what are called closing attorneys. That's perfectly fine. We work with them also. But I've also set up exchanges on the East Coast where people are buying in California. Some people actually are exchanging into California. Not as many as out, but you're still seeing a lot of money come in as well. But yeah, we work with you throughout the transaction. Everything that we do is done, via email and via the title company. So there's not like you'll ever have to come to our office to sign any paperwork.
Got it. Yeah, that's just good to know that, it would be a smooth one-point contact. How can you load up our presentation about like property? Yeah, Ron, I'm going to take a few minutes, just maybe 2 minutes before we wrap it up. In the meantime, just see if there are other questions. So for people who are planning to do 1031, we do have a 5-plex now active on the market. It's in Newark. It's a townhome style and is in good condition, 100% rented, and is asking for $2.25 million. Each of them is a 2-bedroom, 1.5 bath, and each of them actually, the unit will have a 1-car enclosed garage. Like tenants love it because they can use it for parking or storage. And there's a single home in Union City, which has a 5,000 square feet lot. It is at the price of a condo. It's $799,888. It's not a big one, but it's actually a single home with land, and currently have a tenant stay in place. If you're thinking about 1031, you could take it over. And current rent is a little below market, it's about $2,000, but the market rent is about $2,300. So if you're thinking about buying a property for, say, expansion, or you're thinking about building an ADU, Union City does have very flexible roof for adding ADU, only 5 feet away from the main home. I have a client just did it. So that might be a potential candidate if you're thinking about Up Lake. And we also have another listing coming up. It's a 2-bedroom, 1.5 bath, only 7 years new in North San Jose. The asking price is about $950,000, and we currently have a tenant in place that will be moving out end of this month to make it a primary residence if possible. Thank you very much. And I do have one more question that just came up from JS. To determine on the replacement property minimum price to meet, what closing cost deductible for the purchase time? I think that maybe John, I think he came in late. Maybe, do you mind in repeating again what closing costs deductible for the purchase time?
Well, the main closing costs are the realtor fees, because that's the biggest one. But you can also subtract the escrow fees, escrow, title, transfer tax. The problem is, some of the nickel and dime stuff, some of the very, very inexpensive stuff, the IRS doesn't give us black and white rules on them. So a lot of it is open to interpretation by your accountant. But for the most part, title, escrow, transfer tax, and realtor fees, those are the big ones, the biggest fees. Those are all considered to be closing costs and can be deducted.
Yeah. So I recently closed on a property in Florida. I pay off the solar, which is part of the house. I hope that solar panels actually can be included in in the exchange price. Is that
I
right?
I would think so. You know, I'm not an accountant, but I would think so. Only because it's actually part of the real estate, and which is why you're buying it as part of it. So I believe you can, but you know, I would get that confirmed with your own tax advisor.
I see. And I try to pay off the Melrose because they have like what they call by a CDD is a development improved duty, just like Melrose in California. But they told me that that is not deductible for
Right.
my proceeds.
Right.
Is that correct?
That's correct. Right. That's property tax. That's property tax related. That would not be a closing cost.
That cannot be considered as part of the purchase side
No.
for the net proceeds. Okay.
No, because
Yeah,
it's not
very
it's not
good.
considered part of the improvements of the property.
I see. I see. So, well, we covered quite a bit today, but I'm sure that you might have more questions. And please feel free to reach out to Ron directly about your exchange question. If you want to talk about real estate, reach out to us. I'm Monica, and we're going to send out the presentation of Ron within this 2 or 3 days. So you see a copy of his PowerPoint, and then it will be on YouTube on the recording. So feel free to review it or share it with your friends. And I do hope that you can have a very smooth exchange and work with Ron on it. And we will be happy to help if you have anything we could do. Okay. Thank you so much, Ron.
Thank you, Monica.
Thank you. And wish all of you have a wonderful rest of the weekend. Thank you.
And hopefully next time we do this, we'll be back in person again.
Yes, yes, I hope so too. Yes, definitely. Thanks so much.
All right.